next $350 billion installment of the financial rescue plan later today. At last night's news conference, Obama spoke in broad terms about some of the features of the plan.
That means having some transparency and oversight in the system. It means that we correct some of the mistakes with TARP that were made earlier, the lack of consistency, the lack of clarity in terms of how the program was going to move forward. It means that we condition taxpayer dollars that are being provided to banks on them showing some restraint when it comes to executive compensation, not using the money to charter corporate jets when they're not necessary. It means that we focus on housing and how are we going to help homeowners that are suffering foreclosure or homeowners who are still making their mortgage payments but are seeing their property values decline. So there are going to be a whole range of approaches that we have to take for dealing with the economy.
President Obama in his first news conference last night. Professor James Galbraith still with us, economist, University of Texas, his book, The Predator State. Explain the bailout and what you think should happen today.
Well, the crucial question is on what terms does the Treasury plan to guarantee or to repurchase or to otherwise deal with the bad assets that the banks have. These assets are mortgage-backed securities. They are securities derived from subprime loans that were made in an atmosphere of regulatory laxness and complicity in fraud, basically, during the Bush administration, which came to take over the system of housing finance and to infect it with assets which nobody trusts, which nobody can value. And nobody really knows what's in the files, what's on the loan tapes of those that underlie those securities. So the question that I think we need to ask is, before we issue a public guarantee, does the Treasury of the United States plan to conduct a meticulous audit of the assets that underlie the securities that they're expecting to take off the bank's books, so that we, the taxpayer, can have an idea of what, if anything, these securities are worth? And the problem is that when you the little bit of checking that has been done appears to reveal that a very large fraction of these securities contain, on the face of it, misrepresentation or fraud in the files. And so we are looking at an asset which no outside investor doing due diligence on behalf of a client for whom they have some responsibility would touch. And that is the issue. That's the problem. If that is indeed the case, then I think it's fair to conclude that the large banks, which the Treasury is trying very hard to protect, cannot in fact be protected, that they are in fact insolvent, and that the proper approach for dealing with them is for the Federal Deposit Insurance Corporation to move in and take the steps that the FDIC normally takes when dealing with insolvent banks. And the sooner that you get to that, and the sooner that you take these steps, which every administration, including the Bush administration, actually took in certain cases, replacing the management, making the risk capital take the first loss, reorganizing the institution, guaranteeing the deposits so that there isn't a run, reopening the bank under new management, so that it can begin to function again as it should have all along, as a normal bank. The sooner you get to that, the more quickly you'll work through the crisis. The more you delay and the more you try to essentially prop up an institution whose books have already been poisoned, in effect, by the practices of the past few years, the longer it will take before the credit markets begin to function again. And as I said before, the functioning of the credit markets is absolutely essential to the success of the larger package, of the stimulus package and everything else, in beginning to revive the economy.
Professor Galbraith, I wanted to read you a little from today's New York Times, which said the Obama administration's new plan to bail out the nation's banks was fashioned after a spirited internal debate that pitted the Treasury Secretary, Timothy Geithner, against some of the president's top political hands. In the end, Geithner largely prevailed in opposing tougher conditions on financial institutions that were sought by presidential aides, including David Axelrod, the senior advisor closer to the president. Geithner will announce the broad outlines today, successfully fought against more severe limits on executive pay for companies receiving government aid. He resisted those who wanted to dictate how banks would spend their rescue money, and he prevailed over top administration aides who wanted to replace bank executives and wipe out shareholders at institutions receiving aid.
Well, I think David Axelrod's instincts in this matter were correct, but it really is not a political issue. This is an issue which should be determined after you have made an evaluation of the solvency of the institution, of whether its assets are sufficient to cover its liabilities. That's a technical determination. The proper authority for making that is neither Timothy Geithner nor David Axelrod. It's Sheila Bair, the chairwoman of the Federal Deposit Insurance Corporation. She has the authority, and she should be the one who's making that determination, again, not on political grounds, not on whether the public is angry, as it justifiably is, over the compensation packages these banks have been paying to themselves, but whether the banks themselves are viable, whether they're meeting their capital requirements, whether they in fact have assets on their books sufficient, as I say, to keep them solvent. And if that's not the case, there's a clear chain of responsibility, and it's not a political decision. It's a technical decision. It's a banking regulation decision that needs to be taken.
But what about Geithner's plan? Again, reading from the Times, saying the $500,000 pay cap for executives at companies receiving assistance, for instance, applies only to very senior executives. Abandoning any pretense about limiting the moral hazards at companies that made foolhardy investments. The plan also will not require shareholders of companies receiving significant assistance to lose most or all of their investment. Some officials had suggested the next bailout phase not protect existing shareholders, nor will the government announce any plans to replace the management of virtually any of the troubled institutions, despite arguments by some to oust current management at the most troubled banks. Finally, while the administration will urge banks to increase their lending and possibly provide some incentives, it will not dictate to the banks how they should spend the billions of dollars in new government money. Professor Galbraith.
Well, when you're dealing with a bank which is essentially solvent, then you can make these judgments. But as I said, when you're dealing with a bank which has already basically rendered itself insolvent by virtue of its complicity, it's basically seeking for easy money, for big profits out of mortgage originations and underwriting fees in the last part of this decade, then you're dealing with a bank which is already underwater. The risk capital is already worth nothing. It's being held up only by the expectation of a federal bailout. The management is the problem with leaving the management in place is that you cannot rely on the existing management to give you a full and fair accounting of what is in the books and what of the bank and what the practices of the bank are. That is why you need to bring in a new team. You need to bring in a team which is nominated by the FDIC, which has as its first objective coming clean, going through the books of the bank and separating the good assets from the bad assets, the assets which have a reasonable chance of continuing to earn income from the assets which need to be written down or written off. Then you can make an assessment of just how big the losses are and what has to be done, whether the bank itself should be closed, which is sometimes the case, whether it can find a merger partner, which is sometimes the case, or whether what you do is reorganize it, isolate the bad assets from the good assets, and relaunch the good assets as part of a new bank. One thing or another has to be done, and when it's done, you can begin to basically grow the economy on the basis of these newly reconstructed credit institutions. But so long as you're dealing with the old management, and so long as you're dealing with the old practices, and so long as you don't have a clean audit of the books, the chances are that the bank is going to behave in ways which are not constructive, which do not contribute to the growth of the economy, and which leave all kinds of suspicions present in the system about the integrity of the institution and of the regulatory process. And that's the problem the Treasury Department seems to be determined not to face. And so long as it doesn't face it, we're not going to get out of this, and the Treasury Department is not contributing constructively to the success of the recovery plan which the Congress is about to enact. And that will mean that the recovery plan itself will be, sort of after the fact, too small to deal with the problem of unemployment, which is just growing at the rate of 500,000 jobs a month. So we are, and that's the dilemma that we're in. And I think that at this point, the Times story is extremely important because it does tell you exactly where the Treasury Department is. But at this point, that's the impasse that has to be solved. And I'm afraid it's going to be some time, since this plan is going to be announced today, before we come again to the realization that the hard choices in the financial system cannot be